You ever have that feeling, you've done everything right, you've done the deep dive analysis, you've found a genuinely undervalued company, but the stock, it just goes nowhere. Or even worse, it just keeps drifting down? Well, what if I told you the reason has almost nothing to do with the company itself and everything to do with the market's hidden plumbing? We're talking about liquidity, and right now, somebody is turning off the main valve. So let's trace the pipes.
I know, it sounds like something out of a science fiction movie, but it is happening right now, in plain sight, if you know where to look. While all the headlines are obsessing over these quarter-point, half-point interest rate hikes, there's a much bigger, much less understood force at play. The Federal Reserve is actively, and I mean actively, removing US dollars from the financial system. And that is the core of what we're tackling today. You see, this whole process of deleting money, it creates this massive headwind for asset prices. We're talking stocks, crypto, real estate, you name it. It is a liquidity drain that can literally overpower even the best company fundamentals. Understanding this one concept, well, it's the key to seeing the market with a brand new, much clearer lens.
All right, so here's our game plan. First, we're going to break down what this disappearing money thing really is. Then, we'll take a trip back to the Great Flood of Cash, also known as quantitative easing. After that, we'll see how the Fed is now pulling the plug with something called quantitative tightening. I'm also going to show you exactly how you can track this drain in real time. Then, we'll really get into why in this market, liquidity is king. And finally, we'll put it all together to give you that powerful new lens for looking at the market.
Okay, first things first, we need to be on the same page about what we mean when we say money is disappearing. We're not talking about some guy shredding dollar bills in a basement. No, we're talking about a concept called liquidity. To put it really simply, liquidity is just the amount of cash sloshing around the system ready to be invested. Think about it this way. If asset prices are like cars, liquidity is the gasoline. It doesn't matter if you have a Ferrari engine. Without fuel, you're not going anywhere. So more liquidity means more fuel, making it easy for pretty much all assets to go up. Less liquidity means that tank is running low and it becomes much, much harder for prices to rise, even for the best companies out there.
So, to understand why that fuel tank is running low right now, we first have to talk about the massive refueling that happened over the past decade or so. This was a policy called quantitative easing, or QE for short. And let me tell you, this was the great flood that lifted all boats, even the ones that were full of holes. These two policies, QE and QT, they're perfect mirror images of each other. With QE, the Fed basically creates new digital dollars out of thin air to buy things like government bonds from banks. And boom, that injects cash directly into the financial system. But with QT, which is what's happening now, that whole process goes in reverse. And they don't just pull the cash out. They effectively delete it from existence.
Now, this process went into absolute overdrive during the pandemic. I mean, to keep the entire economy from just freezing up, the Fed stepped in and started buying assets on a scale we had never seen before. They were essentially turning government debt into cash and just flooding the market to get a stalled economy moving again.
And the scale of this was just staggering. The Fed's balance sheet, which is really just a record of all the assets it owns, it doubled. It went from an already high $4 trillion in 2019 to a peak of nearly $8 trillion. That's $4 trillion new dollars injected into the system, all looking for a place to go, which of course pushed up the price of everything: stocks, crypto, houses, even used cars.
Okay, but now, to fight the inflation that all that new money helped create, the Fed is pulling the plug. They've started this process of quantitative tightening. And this is how that $8 trillion pile of assets begins to shrink and how money literally gets deleted from existence.
I absolutely love this description because it really captures how bizarre this whole process is. When the Fed does QE, they just create money with a keystroke. Well, when they do QT, that money just vanishes in a similar way. It's not like it goes into someone else's bank account. Nope. It's just removed from the total money supply, as if it was never even there. Poof.
So how do they actually pull this off? It's really a three-step process. First, the Fed just stops reinvesting the money it gets back from its maturing bonds. This is kind of the hands-off approach. Second, as those assets mature, the cash that's paid back to the Fed is just extinguished, gone. That shrinks the money supply automatically. And third, if they really want to speed up the drain, they can actively sell assets directly into the market, which forces everyone else to use their cash to buy them, pulling liquidity out even faster.
Okay, I get it. This all sounds super abstract. But here's the crucial point. You can actually watch this happen in real time. There are two key dashboards you can look at to see the money literally leaving the system, and right now they are both flashing some serious warning signs. The first and honestly the most direct indicator is the Fed's balance sheet itself. You can see the whole story right here in this chart. See that massive expansion from 4 to 8 trillion during the QE flood? And then you see that noticeable dip more recently? That little dip, that is QT in action. That is the visual proof of money being deleted. And every little bit that it dips represents a headwind for the market.
All right, the second indicator is a bit more obscure, but believe me, it is incredibly powerful. It's called the Reverse Repo Facility, or RRP. Now, the easiest way to think about it is as a parking garage for all the financial system's excess cash. When there's just way too much liquidity sloshing around, banks and money market funds, they park it at the Fed overnight for a tiny risk-free return, because there's just not enough good places to put it.
Now, look at this timeline. It shows exactly what's been going on. At its peak, you had over $2 trillion of excess cash just parked here. That's a clear sign of a system that was completely flooded. But look at the trend now. It is falling off a cliff. This means the system is burning through its cash buffer to buy things like new government debt. And as this number gets closer and closer to zero, you better believe financial conditions get way tighter. The safety net of excess cash is disappearing.
And all of this brings us to the most important part of this whole explainer. Why should any of this matter to you as an investor? Well, because in a market that's shaped by central bank policy, liquidity isn't just a factor, it's the factor. It is the tide that either lifts all ships or leaves them all stuck in the mud. And here it is, the brutal truth that a lot of investors are waking up to right now. You can have a company with a perfect balance sheet, amazing earnings growth, and a valuation that just screams, buy me. But if there are no new net dollars coming into the market to bid up prices, that stock can go sideways or even down for a long, long time. The flow of money simply trumps fundamentals in the short to medium term.
I mean, the historical evidence on this is crystal clear. This quote just captures the market's reaction perfectly. Back in late 2018, the last time the Fed tried to shrink its balance sheet, even by a little bit, the market threw a complete tantrum until they backed off. The market, for better or for worse, is addicted to liquidity.
It all boils down to that old Wall Street saying, don't fight the Fed. For a decade, that meant you should be bullish while they were printing trillions of dollars. But now, that rule is inverted. Fighting the Fed today means being bullish while they are actively draining liquidity. And look, the correlation is just undeniable. When the Fed's balance sheet went vertical, the S&P 500 soared right alongside it. So as that balance sheet now shrinks, it creates this powerful gravitational pull on the entire market. So, armed with all this knowledge, you can now look at the market through a completely new lens. It's a framework that lets you see past the simple company-level analysis and look at the bigger, systemic picture that's really controlling the wind at your back or in your face.
All right, let's lock in the key takeaways here. First, monetary policy is so much more than just interest rates. You've got to watch the plumbing. Second, the Fed's balance sheet is basically your macro roadmap for liquidity. Third, the reverse repo facility is your dashboard for the system's dry powder. And most importantly, always remember that in this kind of environment, the tide of liquidity can easily overpower even the best company fundamentals.
And this all leads us to one final provocative thought. The old way of thinking always starts with valuation. But maybe, just maybe, in a world dominated by central bank actions, the most important question isn't about the specific asset at all. Maybe the first, most critical question you should be asking yourself is this: am I swimming with the liquidity tide, or am I trying to fight against it?